Good morning, traders. Today is November 13th, Sunday. It's early in the morning. This is Brad Matheny. We are going to go over the MENT Rotational Modeling System, the custom real estate modeling that I produce every Thursday when the data comes out, and the general market analysis going forward for the next week to roughly, let's call it 10 days to 60 plus days in length. So this is your chance to understand what I'm thinking, what I see happening, and where my modeling systems are producing signals and data. So let's briefly discuss what's gone on over the past couple of weeks. We've got the Fed raising interest rates, 75 basis points, putting more pressure on global assets and global economies. We've got a collapse in cryptocurrencies that's taking place right before our eyes over the last couple of days. It's just an incredible uh, uh, time to live. I mean, really, this is probably one of the most wild times in history with regards to digital assets, digital currencies. What the world is doing, hundreds of millions of dollars have flowed into these currencies is an alternate form of asset, and I've mentioned before, I keep calling them like beanie babies or tulips. It's the most wildest thing ever. Back in 2013, 14, when I was first introduced to Bitcoin and alternate currencies, Wilco, I'll thank you for that if you're still around. Long and short of it, I was very hesitant about it. I was astounded at the value that was eventually found in Bitcoin, 60 grand or higher. And I really, continue to believe that this is an extreme speculative phase. I mean, everybody piled into the idea of decentralization and not run by global central banks and alternate forms of currency and could replace the dollar and so forth and so on. Now we're living in a world where it seems like every couple of weeks somebody defrauds or gets hacked or absconds with millions and millions of dollars through shady business dealings. And I think the real process here, ladies and gentlemen, is that we're going through an extended unwinding phase. So think about like this: capital, from an investment standpoint, wants three things: safety, away from risk, okay, security in the sense that it has some intrinsic value that can be relied upon and based upon going forward. So that's going to provide, the ability for your investment to actually hold some value. And then return on investment, moderate return on investment over, say, 6 months to 48 months or longer. And really, what does crypto and Bitcoin provide? Now, Bitcoin is a separate beast. I know I don't want to anger the Bitcoin people saying that Bitcoin is intrinsically different than altcoins and cryptos, and that is true. Bitcoin may have an intrinsic value simply because of the mechanics of the Bitcoin process, mining and structure, whereas a lot of these altcoins and cryptos are essentially just, vapor value. There's really very little holding it up in terms of true assets, true valuation, and hard assets behind it. But again, what's happening now is capital always seeks those three things. They want safety, security, and return on investment. Safety in the sense that they want, moderate, safe environment to continue to grow and continue to invest. Security, they want some sort of a hard asset. Money wants some sort of a hard asset, some real tangible value that you're invested in, and then of course ROI, return on investment, the opportunity to grow. And that's my true belief. Capital will always seek the safest, most secure, strongest ability to generate ROI. And right now, I don't believe that cryptos or Bitcoin or, for example, real estate really is where that money, where capital is flowing. I believe there's a very strong outflow taking place in this space, cryptos and Bitcoin and alt currencies, and it's money is moving into more secure assets. So as we get started here, before I get into the rotational modeling system, let me come over here and show you that These are my custom index charts from the other video I produce every week. Consumer engagement, which is this chart, has rebounded here in November. It is in a downtrend. We are seeing consumers start to engage in the economy. There's still a large number of people, believe it or not, in the world that are not involved in the crypto space or the Bitcoin space. And so there is a very good chance we will flag out into a sideways melt up type of trend here as capital moves away from cryptos and into more traditional assets. And I'm going to show you how I believe this is already taking place right now. So we're watching right now. We've got 2 months into the end of the year. Then we start in early 2023. I'm expecting a melt up, maybe 15, 20, 21% maybe in the US and global markets, but it's going to be more of a, instead of a straight up rally, I think it's going to be more of a melt up with a lot of volatility. And it's going to be kind of a slow slog higher. Now, next we have the, let's go here, the US to global index. The US is in blue, the global index is in red. You can see had a big turnaround last week in the global index. And these are investors chasing this double bottom setup in the global foreign markets, Europe and Japan and others, China inclusive. The US market is starting to move higher as well, but we're still slogging across this high, these traditional channels. You can see these downward channels here, and we still need to see it get above these channels. So we're still in a very risk on environment in regards to capital is redeploying back into traditional US and global market assets, stocks, and trying to take advantage of the recent bottom that's taking place. But we're not in a solid uptrend yet. So we have to be extremely cautious right now. We cannot jump the gun here. And I would urge everyone to stay patient until we get some real solid confirmation going forward that we are breaking these downward channels. So for example, if you hypothetically draw a line right across here and draw a line right across here, you're going to see that we're just below that line. And again, we can probably see it very clearly right here. This is the same type of a downward channel. We need to get above this upper channel here to start to see some real upper growth. Right now, we're trying to hammer out a bottom. We're trying to, this is like an early stage basing momentum pattern, but we are not anywhere near bullish trending and bullish price advancement. We're trying to hammer out a bottom. So now we're going to come back over here to the cash flow index. This is one of my newest custom indexes. It's very impressive, actually. You can see how the cash flow index rolled downward here very quickly in early 2020 before COVID, and actually while the market was stalling. You can see how the cash flow index rolled downward here in June, July 2021 and started forming lower highs, lower lows, while the US stock market, the SPY, was forming higher highs. You can see the same thing back here in 2018, peaked, rolled over very quickly, continued to trend downward until we had this base, and then started to move back upward here through this growth phase. We're starting to see a very big reversion trade here in the cash flow. You can see here this has moved quite a bit higher. We're back up near this resistance area, this previous peak. We've got to see it move a bit higher. It's got to literally attempt to rally a bit higher, which I believe it will do. And I believe it'll push the SPY back up into this previous peak level here, probably close to 408. I'll take a look at it on a chart here in a minute. But long and short of it is we're seeing cash move back into the US market. And this is a sign that there's a lot of capital coming into the US markets and foreign markets. And it's basically a redeployment of capital off of this deep low here. So where's a lot of this capital coming from? I believe it's coming out of the crypto and Bitcoin space. I believe that a lot of people are suddenly realizing the unwinding of that space is going to present some real risk to their hard assets. Nobody wants to see another 30, 40, 50, 60% decline in hard assets when you can move that money out into something more stable and in a bottoming type of formation with some real safety, security, hard assets, and chance of ROI. So I believe we're seeing a very big shift right now take place in the global markets, and a lot of the capital, which again could be literally billions or hundreds of billions of dollars, moving out of the crypto space and into actual stocks and hard assets such as gold, silver, platinum. I believe we're seeing a very solid reversion trade setup. Now, will it prompt a massive rally? I don't know. What I do know is that a reversion trade back up into this area, 160, 165, is very, very likely. Will it continue to push higher? I don't really know. It's going to play out over the next 60 days, and we're going to be able to tell. But right now, I don't have any real confirmation that we're in a massive uptrend. We've seen this massive reversion here, and it looks like it could be starting a good uptrend, but it could stall out. It could weaken. There could be some other news, some collapse. I don't know what it would be, but right now with the news going on with the crypto space and the global markets and the elections and the Fed, my urging is to stay extremely cautious. We could move into kind of a sideways melt up period, which means we could see some opportunity, but nothing to get overly aggressive with. Next, we're going to look at the US Custom Valuations Trend Index. This is a proprietary charting system, it's a custom index. We're finding support down here. It looks like we're going to see some sort of an upward bounce here off of these historic lows. Remember, this is 2011, 12, all the way to now. So you're basically looking at almost 13 years worth of data from the bottom in 2008, 9 over here on the left side, all the way across, and you're seeing this rotation here in the middle, which I find very interesting. So right here, 2012, we reached a peak. 2016, we reached almost the same peak, nominal new highs here. 2018, we reached a low in late, looks like early, sorry, 2018. Then we started to accumulate higher up until 2020, and we started to roll back downward from 2020 onward. Why is this so important? Is because this is the COVID collapse. And what we're trying to do here is we're trying to measure actual strength. So when you take a look at this, the bottom here in early 2018, the peak up here in early 2016, the peak up here, the real peak here, but we'll call it here in June, July 2020. And now we've come back down here into this rotation. This is a real unwinding of capital. Even though we've seen great equity growth as at the hands of the Fed and speculative traders, what we're not seeing here is real organic growth. If we move into this trend that starts to move organically back to the upside, we may see some real organic growth. We may see some trending that lasts into 2023 and beyond. But right now we're seeing no real organic growth. So what that means is that we are seeing this cash moving into the market is a sign that traders are attempting to bottom pick. They're attempting to move into undervalued assets, expecting some sort of a Christmas rally. What this means here is that we're seeing it happen in the US market and in global markets. Global markets may be more so right now as a deeper bottom. And what this means here on the next chart, the consumer index, is that consumers are still yet not engaging the way we want. We would like to see consumers move more aggressively into the markets and start to prompt an economic recovery. Obviously, with interest rates high, collapsing prices on assets like cars and homes and inflation and others, this is going to probably stagnate out, flatten out. Next, we're going to see the volatility index, which is weekly, and this is telling us that we're seeing a bit of a upward trending, a bit of a bullish mode. Remember, anything below 6 roughly here, the red line, is considered moderately to strongly bearish. Obviously stronger down here to the bearish side. And then we've been in this downward cycle trend since June, July of 2021. We need to see some break of this trend. And what I'm concerned about, ladies and gentlemen, is we might see this move back up here to 11 or 11 and a half up into this resistance area. You can see how this resistance area has moved downward. I'm thinking we might see this move back up here and then stall back out again. Now, hypothetically, ladies and gentlemen, if we count the waves here, we have a one wave up. We can count this as a two down to here through extended trending. This was the June, July low in the markets in 2022. We have a three, we have four. We may be moving into a breakout wave five here. But seeing as though this actually established a new deeper low, we may call this A, B, C, D, and then an E to the upside. So we may have one more big rotation to happen, and it could be a further unwinding of assets. So I need you to be very, very cautious that any move here until we have confirmation is really very fragile. So do not get aggressively involved in the market yet. Based on my analysis, we're still not seeing any real organic growth. Remember, we have what I'm warning you, we have no organic growth in the custom valuation trend index. We have no consumer, whoops, wrong one. We have a moderate cash flow, potentially reverting back to a possible upside move over the next 60 days roughly. We have no real consumer engagement yet. Yes, we've come down off of these lows, or come up off of these lows, but we're not seeing real strong consumer engagement yet. And that's because the Fed pressure, interest rate pressure, and deflating hard assets like homes, cars, and others are presenting a real issue. So what we have here is a very mixed market. And that's why what I'm going to go back to this and show you that the MENT rotational modeling system is still weekly bullish on the SPY, daily bearish on the SPY. That nets us into a 50% bearish SPY allocation, 50% cash. We're in a net flat position. This last quarter has really been kind of a flat quarter for the MENT rotational modeling system. We've seen some activity, some real growth, but net, we're not seeing any real asset growth this last quarter. And it looks like this year is going to possibly, depending on what happens the last couple of months, we may end up being, net negative 4% to net plus 4%, depending on what happens over the next couple of months with the long-term investment rotational modeling system. We follow this for our investment, our hard assets, our retirement accounts. This is the basis of all of these shorter term strategies. So remember, this is telling us that we are mixed. We should be essentially 50% bearish on SPY, 50% cash in our long-term portfolio, and in our short-term portfolio, we are not seeing any new trending. Now I changed these. I took away the Dow Jones here because it's reported right here in the E-mini futures, and I replaced it with the mid-cap. What I found interesting is the mid-cap moved to bullish on daily just last week. So we're seeing some mid-cap buying. This could be where market capital is flooding into the market. So we may not be seeing large caps moving higher. We may not be seeing too much involved in technology moving higher, or small caps, but it looks like we are seeing quite a bit of buying activity in the mid cap area, which are again, these could present a good solid 20 to 25% bounce if this trend continues. Everything else is still the same. Our allocation levels are 10% stock, 65% cash, 25% metals. And again, I'm going to talk about metals here in a bit, but understand that metals are really starting to do what they're supposed to be doing. And the reason metals are starting to come to life right now is there's very real fear in the market. And people are starting to realize that digital vaporware assets that could collapse 40, 50, 60% on some fraudulent scheme by somebody to disappear with hundreds of billions or billions of dollars is really not a hedge against much of anything. It's more like the Tulip craze, or as I mentioned last week, the South Sea Trading Company. So metals are getting a really big bounce right now simply because I believe a lot of investors are starting to realize a proper hedge against real risk, global and or vaporware, is hard assets, hard metal coins and bars that you can hold in your hands, and you can actually have a real store of value, real store of safety, and a real tangible asset with some return on investment. So metals again are going to become very key focus going forward, and we may have a 4 or 5 year solid run here. Crude oil is mixed. Silver and gold right now on my rotational modeling system have still not turned bullish. On the alternate allocation level, we've got 10% stocks, keeping our trading very minimal right now. The idea behind this is to limit our risk. You can still trade, you can still pick a couple of good trades, but just trade with a very, very small amount so that you're not aggressively risking large amounts of capital. Keep most of your money in cash, and we're waiting for bonds to show a good sign of a bottom. They are currently holding near, at least TLT is near the 99 level, which is great. We want to see it try to hold in a shift, but we're not seeing any real upward trending. And then, of course, this is the metrics for the rotational modeling system. You can see as of the end of October, we were minus 6.22%. Remember, ladies and gentlemen, that the market has moved a bit higher now. We've seen a couple of weeks of upward movement. This is now going to probably flatten back out around 4.2 is where it would probably be right now, and we'll see how it holds up. The MENT Rotational Modeling System in blue is designed to outperform the S&P on an ongoing basis, and the way it does that is that it allocates capital more efficiently than a buy and hold strategy. Okay. Okay, next, let's go over here to the real estate market. Real estate has just gone kind of nutty. You can see here the yellow line, the price reductions count is back above 100%. That means that more homes are coming on the market and they're being reduced just almost immediately. Price reductions are, when you get the price reductions at 105% or hypothetically 110%, close to where they're at right now, that's telling you that everything on the market is being reduced. And the reason behind that is that people are trying to get out and get the best price they can before we start to see massive reductions. We do have new active listings at the highest level in the past 5 years. We have median price values about ready to turn negative. That's this deeper blue line right over here. It's very close to moving into negative pricing right now, year over year, which would be a big change compared to what we've seen over the past 6 or 7 years. Median days on market is staying relatively flat. That's because, like I said, ladies and gentlemen, homes are just not really moving. If they are moving, they're being pulled off the market and or sold to select buyers, but we're not seeing a massive increase in homes on market, and buyers are like nowhere to be found. We are seeing reduced share, which is this light blue line, climb higher and higher and higher. So this is a price reduced share year over year has turned positive. You can see here the modeled price demand is moving downward again. Now, I do expect this orange line, the modeled price demand, to at some point move back below this price level, the blue line. So the blue line represents price factoring. Price factoring right now is minus 39.22. It's moved minus 3.56% last week. Okay, that's a very big move. Think of it as prices have now decreased again by roughly another 4 to 5% as we move forward, and this will continue to probably move downward again. This is a measurement of historic activity, so you can see from this level we started at 0%. We've gone all the way up to a price factoring of 50%, meaning prices were very hot back in 2022. You can see this. You can see it's modeled demand, and now we're back down here to minus 32%. We've seen almost an 80% shift in actual price factoring. We've seen an even bigger shift in actual demand. Demand was very, very high here in late 2021 and early 2022 before the Fed started really raising rates, and now demand has fallen completely off the cliff. You can see demand was down almost 4.5%, or sorry, 2.5% last week. It will continue to fluctuate downward, in my opinion. So now let's come back here and move to, whoops, wrong direction. Real estate price trends. You can see real estate price trends have flattened out. And this is again modeled price trends. So you can see we had a big spike in pricing in May 2020. This was after COVID. You can see it shot up and then reverted a bit, then flattened out. Then we had some more moderate price trends. We've just seen price trends move downward in May, June, and July. They flattened back out, so we're not seeing a huge variance in prices right now. It's going to probably move downward again. The reason I mention this is if you take a look here at June and July, we start to get, this was 2022, can't really see it here, but we're starting to see this big uptrend, okay? And this is in price reduction activity. This is probably going to shoot up quite a bit higher over the next 6 to 12 months. And we're getting active listing counts are moving back into the positive. Listings are starting to flood back into the market. Foreclosures are starting to flood back into the market. We'll see how this plays out over the next 6 to 12 months, but in reality, we're getting a big shift moving forward. New count listings, again, new listing count is 42%. That's this blue line. This is telling you where we're at right now. This is the highest level that we have been in years. Homes, there are homes on the market, there are foreclosures that are coming, and I expect the inventory to continue to increase. Now, I'm going to show you on the next page the real valuation of that inventory. New count change, which is this orange line, is a minus 0.68. So in regards to how many new homes are in the market, we haven't seen a big increase. This is a week over week change, and new count share of market is relatively flat. What this is telling you is that there are homes that are being pulled off the MLS and new homes that are coming into the market, but we're not seeing a big influx of them yet. So when you take a look here, active listing counts, you can see that it's moved higher, but it hasn't moved dramatically higher yet. This is a pretty big move, and remember, this is over the course of the last probably 8.5 weeks. So we've seen a pretty big increase in active listing counts, but as of week over week basis, we didn't see a big increase week over week. And now I need to find the other one. Oh boy, okay, let me find it. Hold on. Real estate metrics, here we go. Okay, let me resize this. I thought my data and my charts were a little more organized, but okay, real estate heat rank. This is new to the market. I created this a couple weeks ago. This is one of my strengths is to be able to take data and manipulate it into visible form or quantitative form so that we can actually see what's going on more clearly. So heat rank is an idea to show you how hot the market is. Okay, so here we have a scenario of post-COVID. We had a big heat spike over here. It came down, flattened out. Early April, May, June, this is when the housing market was super hot. You could see it got really hot again. Then it completely weakened. It just died out. And this was when the Fed started talking about raising interest rates and stomping inflation. This is really when inflation started to become persistent. Since that time, we had a little bit of a bump in the heat rank back over here in June, July, August. These were buyers taking advantage of the lower rate before the Fed actually started moving very aggressively. Remember, for the past 3 months, we've seen a 75% rate increase and another 75 rate increase here and another 75 rate increase here, and I believe a 50% rate increase back over here. So these were buyers trying to take advantage of the activity before the Fed started really raising rates. Now the rates are starting to take effect. You can see the real estate tightness rank, which measures how tight the market is. I think of that as how many, is it a buyer's market or a seller's market? And right now it is turning into a bit of a buyer's market, but buyers are not participating. They're very slow to participate right now. So this would essentially be a seller's market up here, name your price, get it. This would be a buyer's market trying to buy below current prices, but again, buyers are not participating. We're not seeing that really happening. And that's translating into very weak inventory strength. Inventory is active listing, what's on the market, how strong is that inventory? In other words, can it hold a price? Can it demand a higher price? Is there very strong demand for inventory? And inventory is weakening. Now, we need to see this play out. I do expect this to move down below 10, minus 10%, minus 15%. And I do believe to see this tightness indicator actually move down even further. I would expect this heat rank to move down below 10-15% here fairly quickly, probably into February, March, April of 2023. And lastly, we have the seller desperation index. This is relatively proprietary, and I'm kind of keeping an eye on it to see if the mathematics work the way I want. But this is going to be hopefully a measurement of seller desperation. And the idea behind this is we want to see when sellers become desperate, they will aggressively move prices to levels to get out of assets that they can no longer afford or at risk of losing. This would also show a spike in foreclosures, potentially as sellers or homeowners try to dump assets before the foreclosure takes place, which would again dump it at market rates. So right now we're seeing a little bit of a seller desperation. It's up to 41. We're seeing inventory strength at this is a change. So week over week, seller desperation increased 41%. Week over week, inventory strength increased by 0.34. You can see a little uptick right here. Week over week, tightness fell 22.7%, meaning that it is really becoming more of a buyer's market. Prices are declining. There is no more rally phase. Buyers are waiting to get the right price, waiting for the right deal, and are really holding off from making speculative buys. And the heat rank moved downward by 0.28, indicating that the market is losing strength. It's losing its hotness strength. So you can see how everything is playing out. Real estate looks like it's going to really take a tank. And I think if the Fed tries to raise interest rates again, you're going to see these numbers play out even more. It's just a matter of time, in my opinion, before we start to see some real strong downward trends and new foreclosures. Okay, now I've spent quite a bit of time going through all this. Let's take a look over here at the NASDAQ. And what I want you to pay attention to, this is a daily NASDAQ chart. And what I want you to pay attention to is the fact that we have moved up here. I'm going to spread this out. Well, actually, I need to leave it here. We've moved out to up to this resistance level, very close to this Fibonacci price level. And I want you to pay attention to this deep white arrow here. This deep white arrow, this little triangle arrow right here, indicates that this is being measured as current major bottom. Okay, it's telling us that the Fibonacci price modeling system that I use is potentially calling this a major bottom. Now, where would this fail? We would have to get below this level and potentially move downward. Again, this would be that we would now try to establish a new price low. Very much like Elliott wave, the way this Fibonacci price modeling system works is it attempts to predict based on what has happened. These are the prediction lines going forward. You can see here, spread this out. These blocks that you see right over here are the predicted levels going forward. So there's the upward predicted level, the secondary upward predicted level, and the third predicts right up into this resistance area. The downward levels are here, and then there's two that are predicting right down here. So we have a downward prediction possibly at 92.35 and right near historic lows, which would be roughly 10,483. But we have upward predicted levels at 11,902, which we're about 140 points away from. And then we have upward predicted levels here up at 12,500 and 12,850. So what we need to be aware of, ladies and gentlemen, is that this rally has moved back up into previous resistance areas. And now I need you to see where these resistance areas are. They come way back over here, way back in the June, July basing and bottoming levels. These green lines and red lines are what I call the Fibonacci trigger levels. These are important to understand that we have extreme trending and potential trending taking place near these resistance and support levels. So historically, because of these levels, we have a very solid resistance area right over here. And you can see these red levels here. And you see this red level here, red level here. We've got red levels back over here. These are resistance. These green levels are support. So below this level right down here, I'll try to draw it here, into this area, and I got to move it a little higher. Into this area here is resistance. Why is this resistance? Because the Fibonacci price level has indicated it is resistance off these red lines right here. Into this area here where the green levels are, this is support. We're looking for support in this area. Then we have moderate resistance back up here. So what this is telling us, ladies and gentlemen, and the reason why I'm pointing this out to you is I want you to be aware that the next phase for the market could end up being a very interesting roll forward, roll downward, roll forward, roll downward before eventually moving higher. So what we would be looking at is kind of a flagging formation, kind of like this, before we actually move higher. So be aware that we're at a point right now where what looks very, very strong may translate into precious metal strength, may translate into mid cap and potentially small cap strength, but may be very volatile over the next week or two as we enter into a new phase. We're also about a week away from Thanksgiving. So I need you to be aware that where we're at, I've been warning about a potential bottom. I've been warning about a wave 5 start rally. What I want you to be aware of right now is, as I accidentally moved my chart, is that we are very likely near a wicked, crazy, volatile period going forward with these cryptos and with the restructuring of wealth. You may see the markets move up another 2, 3, 4% up into this area in the NASDAQ, but I believe we're going to run into some real consolidation, real sideways trending before potentially we get into another breakout trend. Okay, so again, pay attention long term. I think we're at a very critical juncture where the markets are going to attempt to rally out of this base and bottom. I'm showing you now the weekly chart to show you where the Fibonacci modeling system is predicting. And you can see we've got upward target here at roughly 13,150, an upward target way up here at 16,000, let's call it 400, and an upward target here of 17,000 roughly even. So we've got very solid upward trending. A move above this level here, this 12,182 roughly, would likely then target this 13,175 level. And that moves us back into this next level of resistance. So this would probably be a scenario where if we do see this rally continue and it moves up, we'll roll up into here. We'll roll back to try to reconfirm support here, maybe near January, February, and then we'll attempt to possibly roll higher. Understand that we are now looking for a major bottom. So remember that white trigger that I showed you on the last chart? Here we have the white trigger here on the Fibonacci modeling system. We do not have confirmation of this level being a bottom yet. It does look like it yet, but we don't have any drawn. Let me get rid of this. We don't have any drawn confirmation of that bottom yet. So we're waiting for this to confirm. This is a pivot low. We can see because of this little mark here. We may see a new pivot take place back over here. But if this takes place, ladies and gentlemen, the move is likely to be somewhat muted. Remember, I'm telling you that we have a 2 to 5% upward rally change. So let's take a look here and try to figure out where we're at. If we go up to here and try to edit this percent, yeah, about 11%. So on the NASDAQ, maybe an 11% rally moving higher. Now let's take a look over here at the SPY, the ES. And about the same thing. So we're going to start with the weekly chart. This is going to be important because we're going to go through the longer term, broader aspect of this ES chart before we go to the NASDAQ. Now we have an end of cycle, very important, in December 12th, 2022. Could become extremely important as an inflection point. Could start a major rally, end of year rally, or could be very, very volatile. Okay, so now we have the basing level here. We have the recent peak level here. We have a new intermediate base level here. We have a lot of resistance again here, ladies and gentlemen. I tried to draw these and extend these out earlier. A lot of resistance in this area. More resistance back up here. You need to be aware that as we move into this channel, we're likely to see the same type of weekly trend. So from this base level, moving up, possibly rolling around a little bit into early January, and then maybe trying to move higher into January, February. And that's more than likely what I believe is going to happen as we move forward. So on the ES here, how much actual upward price range do we have before we reach into this resistance level? About 5.5%, maybe 6% on the S&P before we're going to run into resistance and roll sideways. The range here is, as you can imagine, from this level down to this level is about 6% rotation. So we got about maybe 5 to 6, maybe 7% upward here. Then we're going to possibly get some sideways rotation into the end of the year. Then just before Christmas and through the end of December, I expect we're going to see quite a bit of strong upward movement, and that would be a wonderful carryover of the rally. Now, what would this transition to? How would this look? This would basically be an unwinding of risk assets in the crypto space, a strengthening of US dollar-based assets as the foreign markets attempt to find some strength. You can see we've got the white arrow here, which is confirming a major bottom down off of this low. So again, this will stay here as long as this low is protected and safe. Fibonacci is all about price establishing new highs and new lows. So we have a major bottom. We have an upward trending. This could be the very beginning of our wave 5 start or the end of wave 4 to the downside. Now we need to see upward trending. Our upward Fibonacci projection level is at 4137. That's about the area that I'm talking to you about over here where I drew the line. And you can see here as we move forward, we've got this key zone here. And this is what happens when these overlap like this. I find this becomes a very strong zone of support if price is above it. So understand that this becomes an extremely strong and powerful support zone. I'll make this pink. And the purpose behind this zone is that price will attempt to move away from this zone and clearly move higher as long as this zone stays in play. And this is a crossing of Fibonacci projected levels. So we've got a downward level here, which was not necessarily reached. We have an upward target off of this low, which we've already gotten above. This is now an area here you can see off of these levels here, and you can come back down to these levels, this trigger level here. This is an area here where price will attempt to stay away from this level moving forward. And as we watch these levels cross again in the future, we'll get new support levels or resistance levels moving forward. Because price is already above it, this becomes a support level. Okay, so again, very, very important to understand that we have that trigger level that's coming into play. And what I want you to be aware of is that we have this real rotation back over here that's going to likely take place in early December. So right around, in my opinion, December 6th through December 20th, we're likely to see some pretty big rotation to the downside. I will post information regarding the cycle patterns for the SPY as to what it says is going to happen early December. I believe my analysis is 100% accurate with regards to the cycle patterns. We have a continued rally phase for the next couple of weeks, which is why I believe the end of November, early December is going to be a peak. Then we're going to see a bit of rotation into the December 12th through 15th area. Then we're going to see a rally phase into the end of the year on fairly strong expectations of Q4 data. And again, we might see some more unwinding of what's going on with regard to the crypto space. So we've got some really good opportunity here. Oil is likely going to try to consolidate. Traders are going to realize that consumers are just fearful, especially with what's gone on in the crypto space. And that's going to cause a shift to safety, a shift to assets, and understand that technology. Let me come back over here and find the FANGs index. There we go. Technology could have a very big bounce. So I mentioned this to you in the custom index chart. I want you to be aware that technology could revert over the next 2 or 3 months back up into this 180 to 200 area. We're at 129 right now. That could be a 30 to 40% reversion in technology sector. A lot of people are not talking about this. I would, given the scenario that we're in, if you were able to place a small percentage into a fairly safe technology sector, I believe we could see a fairly strong technology rally going into the end of Q4 2022 and into Q1 2023. It's not something I would bet the farm on. As I mentioned to you last week, if you wanted to try to dabble into acquiring very small measured positions here, it could be a nice solid little rally over the next 2 or 3 months. I don't believe it's going to be long term, but I do believe a reversion is likely up into a minimum this level and maximum up into this 200, back over into this area. We'll see where it goes after that. But I believe we're starting to see a pretty strong shift in capital away from speculative assets and towards hard assets that are actually earning money. And remember, even though technology missed in Q3 on many revenues and guidance, it's technology companies are still, especially the big boys, Google, Microsoft, Amazon, others, they're still earning good money. Okay, so you cannot shake a stick at something that's earning $20 billion a year. Even though they were off 3.5% last quarter, they're still earning $20 billion a year and producing dividends. So we may see this become a reversion. And what would happen in this scenario, ladies and gentlemen? Fear sets in. Cryptos are, let's say it, crap right now. Nobody really believes that crypto space is solid. Bitcoin is going down. Money needs to find some safety. Money needs to find something that has those three assets: safety, security, and ROI. And big boy technology stocks may be exactly what capital is looking for, which is why we may see a reversion here. And remember, I'm warning you to still be cautious. I'm not telling you to bet the farm. I'm not telling you that this is a major bottom. I'm telling you that I believe capital is going to start shifting into undervalued assets with strong earnings and strong potential for Q1, Q2 growth in 2023, and technology may be it. The S&P 400 mid-cap index may also be it. All right, guys, that's it for now. I'll try to keep you posted. I'm going to do one more video about this crypto meltdown and what's actually happening. Gold and silver, though, boy, oh boy, what a time to be alive. We could be looking at a big run in gold and silver over the next 3 to 5 years. So hang tight. Everything I've been talking to you about is kind of coming true right now. Okay, here we go.